welcome back to this very special Indianomics on the extraordinarily strong number, second quarter GDP number that we just got this week. The Q2 GDP at 7.6% is perhaps among the best numbers we have heard in a decade. Joining me to discuss this were Shubhda Rao of Quantico, Nikhil Gupta of Motilal Oswal and Anubhuti Sahai of Standard Chartered. Ladies and Nikhil, thank you very much for your patience. Nikhil, the worries about consumption. Do you think that, this will continue, or do you think the fact that there could be more revenue expenditure and that in course of time, the government capex will create its own jobs, will ameliorate this problem? Would you worry about consumption at all?
Lata, I actually fall in the camp wherein I would like if consumption growth slows down.
Okay.
And the growth, whatever growth we get, is primarily driven by the corporate sector. That, I believe, will be the best growth if we get it, even if it means that our headline GDP growth is slightly lower than what we want it to be. We know the primary reason is the consumption growth that we have seen in the past few years has not been driven by a corresponding improvement in household income growth, and that is why savings have fallen. Now, till the time this continues, it is all well and fine, but it has an expiry with it. This kind of growth model is unsustainable, and that is why I'm happy if consumption growth weakens. If corporate investments pick up, that is well and good. That is the kind of growth we need, and that's why I'm particularly okay with weak consumption growth until and unless it is driven by higher and improved income growth.
Okay, well, that was the message from Nikhil's recently published book, The 8% Solution. He strongly argues that we should give accent to capital expenditure and sacrifice a bit of consumption for now, so that we have a sustained 7% growth. Well, Anubhuti, what about the Reserve Bank's policy? We discussed it briefly in the before the break, but do you think, we already saw one microprudential speed breaker, if you please, increasing risk weights on unsecured lending. Do you think more of that is possible in the policy?
So as far as policy is concerned, I think with this such a strong growth number, it clearly gives the MPC to maintain its anti-inflationary stance. Can we see more measures to keep the rates on higher side and contain credit growth? Yeah, absolutely. They have been doing it from keeping the liquidity on the tighter side, macroprudential norms by increasing the risk weights. I think the concern from the RBI is not purely on the credit growth rate number. It's more about the quality. If the due diligence done is not at the desired level from the regulator's perspective, then yes, we can see more measures coming in order to ensure that there is no bubble eventually over next few quarters. But as of now, as our sense is that probably, given that they have just announced it a few weeks back, they would like to see how this finally plays out. I mean, there are two impacts.
Okay.
One is there is a direct increase in risk weight.
It will be a similar policy as the one that went by, where the Reserve Bank sounds cautious but doesn't take any action, correct?
Absolutely.
Okay. Shubhda, do you think that we have to revise kind of the medium-term growth trajectory of the Indian economy? Even the most bullish economists were forecasting a max of 6.5 up until 2030. Do you think we can at least start to question whether that number is, a little bearish, whether we can see a bigger medium-term story?
I think before that, Lata, we need to also keep in mind that we are riding an election cycle, a critical one in the early part of next year, that is 2024. And we need to therefore also see, because typically we have seen private capex usually starts walking on the slow path closer to the election cycle. So capex, is going to take a while to recover fully, in my opinion. The next 3 quarters, we will see the switch of government expenditure from capex to revenue expenditure, also typical of a behavior pre-election. Looking at your medium-term growth, I think what becomes very critical and important is India has done stupendously well in dealing with all the global volatile components that were over the last 2-3 years, with broader stability, be it in the financial markets or real economy. I think the policy reforms reform focus has remained well in place. All put together, it does sow the seeds for medium-term growth to look definitely better. 6.5 is what every economist on the optimistic side would have definitely penciled in. I think we would need to see more traction on ground on various reforms picking up momentum in execution, and then we could look at stage 2 of whether it should be closer to 7% or beyond. As of now, I think 6.5 looks more or less kind of baked in a lot of assumptions, even for the optimists.
Oh, okay. Nikhil, a kind of similar question to you. There is one optimist in me which says that, quarter after quarter, the growth is much better than any of us expected. Remember, Jan, Feb, March, the poll I remember was 5.1%, and we saw a number of 6.1%. First quarter was, of course, 7.8, more or less in line. That was what the polls and I think the RBI number also was. Second quarter, again, we are getting this huge surprise compared to what, when quarter after quarter, the economy surprises on the upside. Should we relook at the medium-term forecast? That's one way of looking at it. The other, the bearish way, is that these are periods when there is high growth and high fiscal deficit. Let's remember, it is 5.9 plus 3% states, 9% fiscal deficit for a 7% or a 6.5% economy. So these steroids will go away. Which is the right way to look at it? Do you think these are steroids numbers and therefore it will wane? Or do you think we have a different grammar of growth?
So, Lata, I will tend to agree with the second point that you mentioned.
Okay.
And we also need to understand India is not the only economy which has actually been surprising on the upside. We have seen extremely strong number, much better than expected from the US economy as well. And the reasons, ironically, are almost similar: the government spending and the personal consumption. And before we talk about slightly long term, before we think of revising upwards our long-term focus, we need to understand that private consumption growth of 3% in 2Q FY24, when we know that personal loan growth, especially the consumption-related loan growth, was very strong in the quarter. So the numbers were very good, the details were very good, but the fact that agriculture growth was only 1%, and we are moving into elections in just 6 months, which means there is a temptation of possibility of the government support to the farm sector, which may be inflationary or which may keep the RBI very cautious in terms of their monetary policy. The fact that private consumption growth is not in line with the consumption loans or the retail loans that we are witnessing, something is missing. I do not have all the answers, but unless I have all these answers, I would not be changing my long-term policies at this point.
Fair point. I mean, that's very responsibly spoken. But I'm going to persist with my optimistic doubts. And that comes in the form of the tax collection. Exactly the number which Nikhil spoke about. It looks like we will have money for revenue expenditure and capital expenditure. The April-October gross tax revenue is growing by 14%, whereas nominal GDP for that period has grown by only 9%. Somewhere tax buoyancy is better, isn't it, Anubhuti? So would you revise your medium-term outlook?
No, not really, Lata. I would say like a 6.5% is a very good number. I think what is disconnecting the growth which we are seeing in, say, personal loans vis-a-vis what we are seeing in the private consumption expenditure numbers from the GDP release is the inflation story. We are all looking at nominal numbers, but if you look at the real wage growth, if you look at the nominal wage growth, it's doing very well in urban areas, it's doing very well in rural areas. But if you start adjusting it for higher inflation, and in case of rural India, food inflation becomes extremely important. If food inflation shocks, if they become persistent, then I think the buoyancy in consumption, which we all are expecting to trickle in because of a good capex cycle, that will take much longer. So I think it becomes extremely important to see if India as an economy is able to bring down inflation in a sustainable manner, because that becomes extremely crucial for household consumption expenditure to go up. I mean, this has been seen if you look at the last 1 decade's data. Whenever real wages in both rural and urban area move up together, the growth in consumption expenditure is extremely strong. As of now, real wages in rural area is weak, and unless inflation story is handled, especially from the food side, I think revising up the medium-term growth story just as of now would be a little premature.
Okay, point taken. Anubhuti, Shubhda and Nikhil, thank you very much for bringing some much needed sobriety to the discussion. I am getting a bit excited. As a reporter, it feels very much like I felt when I was discussing IIP numbers or GDP numbers in 2004, 2005. So there is a desire that we get a repeat of that kind of torrid growth. But as our economists warn us, we should look at some of the red signals as well, red flags as well. The fiscal deficit, combined fiscal deficit is still very high, and it will have to be brought down. So this kind of fiscal deficit of 9% for a normal economy means that the economy is growing on steroids, and the steroids will have to be weaned away at some point in time. Secondly, there is a fear that the job-creating sectors like trade, hotels, transport, communication have not grown as fast. As well, consumption only at 3.1%. So we should not run away that the medium-term story is very good, but we can definitely say that the full-year GDP growth of 6.5%, which the RBI has forecast, will not only be achieved, but a surprise on the upside is very, very likely. Wrap up on this edition of Indianomics. Thank you very much for watching.